Stock market strategies. Now that you have a pretty good idea how the stock market works, let's move to a brief overview of various stock market strategies. A strategy is really a plan of what stocks to buy, an ideal entry price, and a potential selling price. Investors use a variety of strategies in order to make profits. Although there are numerous strategies used by successful investors, here are a few of the most popular investment strategies to help you get started. Buy and hold, compounding interest, dividend-paying stocks, buy and hold forever. Buying and holding stocks for the long term is one of the most popular strategies used by investors and promoted by mutual fund companies and Wall Street professionals. If you hold a stock in a superior company for at least a year, according to this strategy, you will be rewarded with a higher stock price. Investors who bought established stocks in blue chip companies could have made huge profits over time. According to the buy and hold strategy, the only time you might sell is when something fundamentally changes in the company. For example, if earnings grow less rapidly. The problem with buying and holding is there is no guarantee your stock will go up. For example, during a bear market, your stock could fall and never recover. In addition, it takes an incredible amount of patience and skill to find reasonably priced stocks that can be held for a lifetime. Using PE ratios to determine whether to buy or sell. One of the many ways to buy and hold investors, and sometimes traders, determine what stocks to buy or sell is by looking at a simple formula called price earnings, or PE ratio. By dividing the P, or price, by the E, or earnings, you calculate a number or ratio. Although there are a number of methods to help determine if a stock price is fair, the PE ratio is the most popular. First, you should know that a stock price reveals very little about whether the stock is a good buy. For example, is a stock selling for $50 a share a better buy than a stock selling for $10? That is why investors depend on the PE ratio to provide more detailed information. A bank stock, for example, might have a PE ratio of 13. By comparing this company's PE ratio with its competitors or its industry group, you will discover valuable clues whether the stock is over or underpriced. The PE ratio is one of the most popular methods of evaluating a stock. If you don't want to calculate the PE ratio on your own, just look up the PE ratio of any stock on the internet or in the newspaper. Compounding your way to profits. If you prefer to buy and hold stocks, you will be intrigued by the amazing power of compounding interest. According to those who buy and hold, you will make money by reinvesting the dividends and gains you make on your stock. The longer you keep reinvesting your profits, the more your money will compound or increase over time. The problem with compounding interest is that although it is mathematically a sound strategy, there are no guarantees the stock price will go up, that dividends will increase, and that earnings will grow. Although compounding profits is an excellent objective for every long-term investor, no one can predict what will happen in real life. Targeting the stocks that pay dividends. One of the advantages of investing in stocks is you may receive a dividend or a special payment that is passed on to shareholders. It is usually given in the form of cash, which you can use to buy more shares of the stock. Therefore, one strategy is to buy at least 10 stocks from the Dow Jones Industrial Average that pay the most in dividends. Companies that distribute dividends are usually the most well-known blue chip stocks. If you are right, not only do you benefit from a rising stock price, but you receive a bonus in the form of a dividend check. Once again, In a bull market, when all stocks seem to be going nowhere but up, the dividend strategy can be very effective. Unfortunately, there are no guarantees that dividend payouts will continue or that the stock will increase in value. What makes stocks go up or down? No matter what stock strategy you use, you may question why stocks move in one direction or another. It's a good question. Stock prices are influenced by a number of conflicting forces, including the psychology of the overall market, breaking news, whether a company is profitable, and the big one, supply and demand. Supply and demand is another phrase indicating whether there are more buyers or more sellers on a specific day. There is a constant tug of war between buyers and sellers, and the stock price reacts accordingly. Stock prices tend to go up when there are more buyers, and they tend to go down when there are more sellers. In the short term, stocks can fluctuate a lot in one direction or another. Exchange-traded funds, ETFs, the look and feel of a mutual fund. Exchange-traded funds, or ETFs, are investment instruments that look and feel like diversified mutual funds, but trade like stock. New ETFs are created often. Just as with stocks, the price of ETFs constantly changes. Okay, for example, you could buy an ETF that includes only Dow stocks, NASDAQ stocks, or perhaps only the stocks in the S&P 500. The other ETFs include real estate, Chinese companies, or oil. In fact, you can find an ETF for any industry group or sector in the stock market. It's not surprising the popularity of ETFs has skyrocketed in recent years. And because they contain a basket of individual stocks, ETFs can be used to diversify your portfolio. The disadvantage of ETFs is that most like mutual funds, you are investing in a basket of stocks, but without the expertise of a professional fund manager. If used properly, ETFs can be an effective method to increase profits. But because they look like mutual funds, but trade like stocks, it does take some skill to successfully trade ETFs. Selling short. Short selling, betting on a down market. One of the most intriguing but risky trading strategies is selling stock short, whereby you profit from a stock that is on the verge of collapse. It is the strategy of choice in a bear market or when a company's earnings are falling. As you know, when you bought a stock at a low price and sell higher, you were long the stock until you sold it. But imagine selling a stock you don't even own and then buying it back at a lower price. That's selling short. For many people, it is strange and confusing to sell a stock you don't own. In fact, selling stocks short is a valuable trading strategy that makes sense under certain circumstances. If you are flexible enough to consider various strategies, it will give you an advantage over other traders. Selling short is simply another trading tool in your toolbox that can be brought out when needed. Unfortunately, because the stock market tends to go up more than down, shorting is a very risky strategy. When you go on a long stock, the most you can lose is all the money you invested. But when you short, you can lose even more than you invested, which is the reason shorting can be so dangerous for individual investors. Using margin to borrow from your brokerage. Another reason why shorting can be hazardous to your stock portfolio is because of margin. When you short stocks, you borrow shares from your brokerage firm. You will be required to deposit cash into a margin account to cover this short sale. Margin is similar to opening up a credit card at your brokerage firm. But instead of using credit to buy food or clothes, you are borrowing to buy or sell stocks. Some people use margin not only to sell stock short, but to go long a stock. For example, let's say you have $5,000 in your investment account that you want to use to buy a stock. More than likely, your brokerage will lend you an additional $5,000. Then you can buy even more shares. The biggest advantage of margin is that when markets go your way, using margin allows you to earn additional money. The downside is that just like a credit card, you will be charged interest for that loan. Because you are leveraging your money to buy stocks, it's easy to get into trouble. For example, if a stock doesn't perform as you expected, you not only lose money on the stock, but you will have to repay the loan to the brokerage. Stock market strategies summary. Participating in the stock market can involve some legwork. Many investors buy and hold when they buy a stock, like other things, because you want to own it. Some look for dividend-paying stocks or those that have increased their dividends over time and reinvest those dividends or use the dividends for other purposes. Other investors look at exchange-traded funds for diversification. Another strategy more sophisticated investors use is to sell short a stock to profit in the event that the price declines. Congratulations! You have completed our introduction to capital markets course. You should now have a better understanding of various ways individuals and institutions may elect to invest funds and how corporations and governments interact to raise money to help fund their operations. Lastly, we introduced options as a tool to manage some of the risks associated with investing capital and as a means to participate in some of these capital markets. This is just the beginning of a journey to help you further recognize ways you want to participate in the capital markets and to understanding the risks and potential rewards of doing so.